Hello everyone, welcome to the third strategy video. In the first video, we saw what is Batman strategy, and a lot of people have asked for adjustments for Batman. Definitely, I will try to make one after I finish all the 8 videos that I intend to do. The adjustment for Batman will be delivered, I promise that. And the second one was modified long straddle, which is also a very good strategy. And we saw when to initiate the strategies under what market conditions. And today we are going to see another brilliant strategy for high volatile market. It's called Reverse Jade Lizard. This strategy has to be employed in a specific market condition. I will be talking about the conditions in detail because the strategy requires very careful deployment of when you got to initiate this is must known. Otherwise, things can go badly and it is very difficult to make adjustments if you are very new to it. And but at the same time, it's not that you will be losing your capital entirely or anything like that. It is just that you don't want to really lose money after waiting for about 40 days because all the strategies we are initiating for 40 days or 45 days or more than that. So you are waiting for such a long time to make some loss, say about 2000 rupees or 3000 rupees that you lose after 45 days. You will feel that, oh my God, I have wasted all my time, right? I don't want you to go through that. For that reasons, I will be talking a little bit more deeper about when to initiate this. With live charts and market conditions, I will explain that. Okay, in this video, what we are going to cover is what is the capital requirement for the strategy, risk reward ratio, how to initiate it, when to enter, when to exit, and what are the pros and cons of the strategy. And I will talk about the adjustments in detail. There are two types of adjustments that we will be doing here. One is a permanent, month-end contract we will maintain as an adjustment, but you got to pay very big premium to that. Another is to do on a weekly basis, but then if you do weekly basis, probably you can optimize your profits and risk reward a little bit more. So it's all about how much time that you got. Say that you're an office goer, you don't want to really get into this sort of, complicated adjustments, then you can stick with the first option, which is month-end contract as an edge. And more professionally also you can convert this Jade Lizard into some sort of short strangle, short straddle. Many different things can be done, but then that requires more capital deployment and bigger investments. So we will not be discussing that in this video. And also what you should be aware of when you are creating the strategy. That will be the word of caution. With that, we will end this video. So first let's jump into the capital requirement. For this strategy as well, the capital required would be less than 90,000 rupees. I kept it at 90,000 because different brokers will charge different exposure margin. So I cannot be telling exactly how much it would be. For Angel, it could be maybe 79,000. For Zerodha, maybe it will be like 82. So it can differ from one broker to the other. So that's why I've capped it at 90K. So if you have 90K, you can experiment this, do a paper trading and see how this one plays out. As usual, this involves buying as well as selling. And I'm saying selling because if you want to really wait for such a long time, like you are waiting 45 days, and then you are putting in your limited capital, probably all of it you got to deploy, right? And after deploying all that, you don't want to see a loss, right? You will be thinking, if I did an intraday, at least I would have earned some 500 rupees or 800 rupees. But having waited for such a long time, I have not made any money is the very sinking feeling that you will be having after 40 days. So I don't want you to have that. That's the reason we are doing some sort of selling where it ensures that at least you are taking home some money, right? And in total, there are about 3 legs. There is another beautiful thing about the strategy. You can also include a fourth leg for the upside. Call side also you can take an edge. Only thing is it will lower your profitability But then it has its many advantages as well. One, you can get all your positions in capital less than 60K. So you will be able to save additional some 20,000 rupees in the margin requirement. So that money can be used for some other trade purpose if at all you are too keen on that. But my suggestion is that if you get the margin released, say that you have additional 20,000 rupees, you will not be keeping quiet. You will go on to do naked buying. And in this market, if you do naked buying, money will be like trapped. Maybe you want to do average, you don't have funds now. So you will be closing this strategy without you realizing. Market will force you to close this strategy to liquidate funds and then use it for averaging purpose. So for that reasons alone, I am not going to tell you what exactly that you can do. But okay, I can tell you, but probably you can decide whether you wanted to really release that margin funds or not. Okay. And this strategy requires good understanding of where the market would reverse and where it will take some support. So you should have some good technical understanding of where you can expect some resistance and support in the positional thing, because we are going 45 days. At what point market would really reject further climb, those sort of things you should be aware of. If not, that's okay. Still, the strategy can be managed, and I will show you how you can do a very basic analysis to initiate the strategy. And of course, since it is a selling involved, there is a process. The process is that you got to execute everything in a basket order, not as an individual leg. So if you say that you bought and then it involves selling, first you do the buying and then you go on to do the selling. By then the selling price would have come down, and while initiating the position you will be in loss. So you don't want that to happen. Those slippages and all will affect your risk reward. So execute this in a basket order. So let's get in and then talk about the risk reward ratio. Technically, I cannot say it is zero. I can put it zero here, but then I don't want to, because it involves some risk if the market goes in an extreme direction in one side, that is upside, then there is risk. So, but it is also very less probable. So I keep the risk as 1. So if that risk is 1, with respect to that, my reward is 2 times. So it is a low risk and moderate rewards strategy. What sort of thing can be done? You can expect about 9 to 12% of your deployed capital. Say you have invested 90,000 rupees. You can expect somewhere between 10K to 12K after the month end. Sir, what is the catch here? It works under certain market conditions. And what are the market conditions? The market has to be moderate to high volatile. The other thing is that you don't see that the market is going more than 2.5% on the upside. Downside, it goes no problem. You are not going to lose money in the downside. In fact, you will be making good money in the downside. But if the market goes up more than 2.5%, then it is a problem. You got to do some sort of adjustments to bring it back to profitable zones. So these are the things that I am putting it very well in advance. One good thing about market is that, see, market will always take time to go up, but falling can happen any day. Just market can open on Tuesday. As we are recording today, it is 17th of May and Monday is holiday. So Tuesday only the market opens. If there is some sort of global scenario happens, and say that the market opens like say 4% down, possible, or 10% down, possible. This strategy, if you initiate, you will not lose a single penny. In fact, you will make good money. Okay. But the flip side is, something happens, the market is opening 5% upside, then the strategy is going to create a bigger loss. But what are the chances? How many times that the market will open 5% or 10% on the upside, right? It's not possible. But knowing that election results are coming and then something is favorable and then it is opening, say, 10% up, you are having that fear. Then we can also include the fourth leg, which will limit our losses dramatically. And we can also further do the adjustments. Even if the market has gone up like 10%, you can still get out of the trade without bigger damage. And we will discuss all that while we go through the strategy in simulation mode, right? So, how to initiate the strategy? I will talk about it. First part is this strategy is best in Nifty because Bank Nifty 3 days back or 4 days back it was at 47,100 something. Now it is trading way above 48k, almost 1,400 points, 1,500 points of move has happened. Now that is a very high volatile index. Since you are trying something new, you wanted to understand the concepts, I would recommend to start off with Nifty. While you are initiating in Nifty, the thing is you got to observe what is the spot price, and from there minus 200 points lower, whatever is that strike, you are going to sell a put option, and 700 points above, you are going to sell a call option. So this is the writing position, okay? And you have two options. You can also buy edges on the monthly contract, or you can do it on the weekly contract. So I will talk about the pros and cons of it. If you are buying in a weekly contract, you will be paying very small premium week on week, and then do some adjustments to the positions. If you straight away take 80 rupees premium, 100 rupees premium as for the whole month, sometimes if the movement is super fast, then both these legs will become zero. The put option will become zero, and the edges that you have taken also will become zero. Then again you got to make some adjustments and then make money, lose more money. So edges leg at least we can protect and then optimize it. That's what I'm going to talk in detail. So you have two types of adjustments. So the choice is yours. All right, when to enter and when to exit. Enter, create this position at least like 35 days before the next month contract's expiry. For June, it is I think 27th or something like that. And right now, it is the best time because we are on May 17th. We are more than 35 days away from from the expiry. So it's a good time to initiate. Exit is certainly 1 week before the contract expiry. Before 27th is the expiry, you should exit by 21st itself or even before that. So there are two types of exits. One, you are happy with the returns that you have generated, say 10,000 rupees you are getting, you are happy with it, exit it. Or you wanted to wait till the end and then maximize that, maybe it is showing 14,000 rupees you can make. Then you want to wait, but then by 21st you should exit. So 1 week before your main position gets expired, you should clear this off. I'll also give the reasons why when we are doing the simulation. All right. First thing is I will go to Sensible and then show that uh, what is the strategy all about. So there are predefined strategies, right? In Sensible or any other tools that you use, you see a predefined strategy that tells you these are the legs that you should take, and it will automatically create a payoff graph, everything. But in that, what happens is I don't like that. It requires sometimes more capital. Sometimes the profitability can be fine-tuned. If our analysis is very strong, then we can improve the odds of it. It just gives some random, not some random, there are certain calculations with that, but it's not the most optimized way of doing it. So I'm going to show you how you can optimize it. First, before even I step into the strategy builder to show what sort of legs that you got to take, I will show the charts of today and tell you why reverse jade is the best strategy to initiate at this point in time. Okay, so for that reasons, I'm going to get into trading weave. Um, just a moment. All right, we are in trading view. I'm going to maybe keep only one. Um, this is Nifty. All right. Let's say we have seen this happening a couple of times. Market got rejected around 22,700, came down. Again, when it attempted to go that same point, it got rejected. Third time, it got rejected. Now, at the exact same point, it is getting support. You see this? So it is getting some support. So I have drawn these levels. This is my analysis. I know where the market is going to get support and where it is going to get rejected. I've drawn certain levels. These are the levels. So market is exactly at one of the levels that I have mapped. Okay. Now the thing is, downside, I don't know. If the results are bad or whatever, it's against the anticipation. And then if it is going down, it can go any length. Right? I don't know what are the chances for election results to go in favor or against, and whether the market would further go up or down, I don't know. But in case if it is negative, it's going to fall like anything, like 10 percentage fall may happen, right? So going for 45 days or 35 days above strikes and then waiting for such a long time, and then there is a possibility for downside. So we got to protect the downside. That is for sure. Upside, we all know that market has never attempted 23K, right? So whenever it reaches 22,750 itself, there is going to be a strong attack one more time. And when it is making a new high, it's going to get attacked one more time, right? So I know that there are certain levels beyond which it will have struggled to go. I'm not saying it will not go to 23,500 or 24K. It can go, but it won't be an easy ride. It will go and then get tested, consolidate, and then get rejected. For example, here also you see it went here and then it consolidated for some time and then came down. Again, it went up, then came down, right? So there will here this was straight away rejection. But if at all it is getting rejected, it is taking some consolidation. You can take the time to strategize and see what to be done. Adjustments can be done. When it is reaching that level, you can do the adjustments. So one other thing is that you need to initiate this position when you know that upside is going to be a challenge. It can go, but it will not be a easy sudden blast. For example, initiating this position over here, you cannot create the strategy around this level because you know that there is a fierce fight back going to come up. Similarly, when it came here, you cannot be initiating a reverse jade here because you know that there is a potential for it to fire on the upside. So market conditions you got to read carefully and then say that from here, if it is going up, I know this is going to be one level of rejections, and then subsequently as it goes to 23K, it can get rejected. So downside, any amount of fall is okay. I'm not going to lose money. That's what the strategy is about, right? Sounds interesting, I believe. Let's see the strategy now, right? And you got to see how the strategy looks like. What are the legs that we got to initiate? And I will show you the predefined strategy first, and then I will add some modification so that you can choose what you wanted to go with. All right, we are in strategy builder now. I'm going to show how it's done. So here you see there is a neutral strategy, correct? It falls under neutral strategy. And then you see there is reverse Jade Lizard. This is the one you got to select. It will automatically pick up. I have selected the expiry as 27th. You see 27th. And this is how it looks like, right? And you can also see that the margin required for this is about 84,000 rupees. So 84,000 you needed to initiate this. And you can also reduce the margins needed for the strategy by buying an edge. But before that, I will talk about what is that they are trying to do here. You see, the market is currently trading at 22,4, almost 22,450. Okay, and it is going on to sell 450 points lower strike here, right? And then it is buying another 150 points lower strike, and then it is going 250 points above, and then doing a selling of call option. So it is doing a strangle, kind of a strangle it is doing with the downside alone, it is taking an edge. But these are, you see that the maximum profit that it shows is 14,000 rupees for a capital of 84,000 is a very good thing. But you don't really want to keep this much of margin. If you feel that I wanted to reduce the margin, then you can also go to the weekly expiry, like 23rd. And then where is the break even? 23,250, let's say. 23,250. I will go to May month contract. 23,250. 23,250. It's at 1 rupee 40 pice. Maybe I am keeping it because all are like 1 rupee, 2 rupee. I will keep it at 23,000, 23,100. Just like that. Just to reduce even the margin money further. Now, has it shown any sort of improvement here? It doesn't, right? Because this particular strategy, even if you buy an edge of this far, it's not going to be of any value. But the way that I am going to customize, this will bring the margin money drastically. So how to go about it? Let's clear all these things. I will clear all these positions. Go to next month end contract. Okay. And then market is at 22,450, right? So 250 points lower, so 200 points lower is 22,250. Right, 22,250. This is the leg I am going to sell. So this is the leg I am selling. And then I am going 700 points above. 700 points above means 150, 23, 150. Right? Say 23,200. Because this is illiquid strike, I am choosing 23,200. Now, this is a short strangle. So what is so brilliant about this? This is a short strangle anyone can do, right? But here downside risk is more, and you don't really, your risk reward is 17,000, maximum loss is unlimited. Now, at least I wanted to protect the downside. So here there are two options. This is what I was talking about. Here you can go further, like say about another 400 points lower, and then do a buying of this one lot. Now, if it goes down, I'm maximum I'm going to lose 2,500 rupees, but I don't want to lose this also. Then I'm going to buy. Sorry, I'm going to buy something closer. Now 600 rupees loss, and if the market immediately crashes, I am making 2,500. On the expiry day, I am going to lose only 600 rupees. So if you don't want that, then you can go and then take very close by, where like you're going only 200 points below you took this, and another 200 points or 150 points below you took this buy position. So what is that? Downside, you are fully protected. Upside, if the market moves, you are going to lose. And it's immediately it will start showing loss, but then it's not going to be it's not that you are not going to do anything. You can lower this risk dramatically. Now what is the margin required now? 75,000, and I wanted to reduce the margin further. So what I can do, I can go ahead and then, what is that, 23,550, let's say 23,550 in the weekly contract. So 23,550, instead of that, I am going to take 23,100. Let's say one lot I am buying. Okay. Now, Look at the margin. The margin has come to 47,000 rupees. Okay. And this buy leg is only to bring the margin. And but the thing is that it messes up the graph. It looks like so confusing, right? It's not a very good graph. But that's what will happen when you're going for a calendar, multiple calendars, edges that you go. This is what will happen. So for edge purpose, this is added. But in order to see what is happening to your position, you got to uncheck this and then see how profitable it is. Okay. So for only for margin reduction, you are going to enable this, and then this is about 47,000. So every time that you are going to lose some 2 rupees, 3 rupees like that, and then you bring the margins lower. But this leg is not going to be of great value addition for uh, any profitability. But another advantage is also there. If there is a 10% gap up and all these things, then the maximum thing that you are going to lose is 4,000 rupees or 5,000 rupees. That is all that you are going to lose. So this is also going to give you an upside edge. But what are the chances that the market directly opens up 23,500? Straight away, will the market open at 23,500? I understand. Market can open at 1,000 points lower. One attack, some war, some political scenarios going on, some scam happens, 10% downside, it can open. But can it open like 10% upside, 10, or even you see, you are having a coverage of up to 5% in the strategy. So you don't have to really worry. So I'm also going to talk about this particular put option for which we are buying 369 rupees, which I am not liking. Okay, this part I am not liking. So what are my other options? Instead of this, I can go on to the weekly contract and then select what was the edge that we have taken. So where is the break even? 21,500. So just go there. 21,500 is at 5 rupees. This one I am buying, let's say. Right? This one I am buying. And upside also I am buying, let's say. So 47,000 rupees is the margin required. If I am switching the things to weekly, then 47,000 rupees is the actual requirement for the strategy. But no, sir, this is all becoming very complicated. I wanted to keep this strategy very simple. Then straight away go and take this month-end contract of 27th as the edge and maintain the structure. Okay, so this is all I wanted to share about the margin requirements, what sort of benefits that you have by initiating it in current month and next month. So the choice is yours. Now let's go to the strategy. I will show in option stimulator how the strategy works out. And I am also going to show you what sort of things that I wanted to do in terms of refinement. Okay, so this is all the strikes that I have chosen. And this is giving a better payoff, if you ask me. In the previous one, it was showing 14,000 rupees. Here it is showing only 8,000 rupees, correct? That is because we have taken a customized reverse jade, but there is some sort of range extension here. You see, on the downside, we have unlimited range. Anywhere the market goes, you are covered. But on the upside, you are limiting it. So that is the kind of risk reward that you can create. For example, if I wanted more profits, then I can continue to increase this. Not this, sorry. No, I am increasing the puts. Sorry. Puts I have to increase. Strikes I got to go further higher. Yeah. Now you see, the more that I increase the strikes closer to the market value, it is going up, right? And you can also further reduce. So this is the strikes that you are going to choose is also your choice. But then I'm going to give you a very simple formula. 200 points lower put and 700 points far away calls. There is a reason to it, because the fierceness and the volatility you will not be able to handle. And I assume that you have only one adjustment that can be done. No further investments can be done from your end. That is my assumptions. For that reasons, I'm going to give you a zero loss strategy on the downside. On the upside, a manageable adjustments can be done multiple times to ensure that you are taking home something, right? So let's get started with the strategy. So here we are in Opstra, and I have already selected the dates, everything for certain reasons, because today is 17th, and the contracts that previous contracts that's available on monthly basis is 25th. So all our strategies that we are discussing are on 25th. So with that reference itself, I am showing you. And if 1 month before I have to take this, like 35 days before, if I have to take, then the earliest that I can take is on 18th. Okay. And today is also 17th, right? Today is 17th of May. And this looks like very close to the situation for this contract, like 18th of March and 25th April. And we are in May 17th and then June 27th contract. So both add some sort of similarity. For that reasons alone, I am choosing. I can also change it to 14th, 13th. It doesn't matter. It's just that I am, for the sake of convenience, I am taking it. You can change the date to whatever you want, and it's not going to affect in any way. So let's dive into the strategy. I'm going to get the options of 25th first. First, I'm going to get the 25th April contracts. You can see that the spot is at 22K, let's say. Okay, 21,955. Let's round it off to 22K, because next month contracts are liquidity can be an issue in 950 and 850. All these contracts will have liquidity issues. So rounding off to 22K. If I go to 22K, this is where it is, right? And what did I say? We are going 200 points below. So 200 points below is 800. So this 800 strike, I am going to do one selling. Okay. I am doing selling of 200 points below from the current spot, one lot. And I wanted to go 700 points above. And then choosing this strike and then selling this. You will be surprised to see that 200 points below put us at 229, and 700 points away is at 200, right? So that shows how much of bullishness is there in the premiums, right? 700 points away, OTM is having the same, almost same value as 200 points OTM of put. So that is the reason why I said we should be doing a strangle 700 points up, because if there is a small movement on the upside, then all these premiums will jump and you will not be able to manage with less capital. So that's the reason I am giving more range. Probably it will compromise on the profitability. That is okay. If you can do it correct, then surely you are going to get money. And anything about 2% is a great return, they say. And we are going to make more than that if trade goes right. So let's see how it works. So first thing is that we have done this strangle. Now this strangle looks like this. And obviously this will require a higher margin because this is naked selling. Now where is the range here? 21,350 is where the break even is. So I don't want to pay in the monthly contract, because what is that 21,350 if I go 300, 108 rupees I have to pay. For hedging purpose, 108 rupees for 8 weeks, it's saying I don't want to lose so big. So I'm going to take a weekly hedge. So since my main strategy is weekly hedge, let's see what would have happened if I have taken this hedge. So that way, this is how it looks like, right? On the downside, I'm going to lose maximum 8,000 rupees. Upside, I am making 16,000. I mean, if it is in this range, I'm going to make 16,000 rupees, which is pretty good. But if it goes beyond 23k, then I will lose my money. So if this is the case, what would have happened? Probably this is not a very important thing for our discussion. I am going to see in a faster update, like 1 day time frame. For every second it will get updated. You got to observe the profits and losses over here, and I'm going to click on the simulation. Let's check without any adjustments what would have happened to this position. Do we need an adjustment at this point? We will see that. So this is 18th and 20. Okay, payoff graph for, why is it showing? Okay, I need payoff for 24th, right? And yeah, click play. So I'm playing it. Market going up, coming down. 6,000 rupees it is showing, 5,000. Suddenly it is spiking on one side now. Again came down. 15,000. So this is all you got to do. And on the day you made 16,000 rupees, right? So this is great. Why you are not suggesting this? I am making 16,000 rupees. But there is a twist to this. Okay. Here, if you are somebody who doesn't have time and you wanted to do this, you can do this very well. And I'm going to just go to the next. There was a point where it went towards the right extreme and almost at the verge of, yeah, here. So the date is 12th of April. Here you see the market is already over here. Now, if you have to, obviously at this point, you will panic because you see the put is at 5,000 rupees. Sorry, the put is at 10,000 rupees profit, but the call is at 300 rupees loss. So if this one suddenly goes here from further here, then you will already your profit is only 5,000 rupees. In no time it will get into loss in just one move, because we are seeing in 1 day time frame, we are missing out a lot of actions. But then in case if this is the situation, what is that adjustment that I can do? I'll show you. Simply, this range is not needed. It has moved super far away. Go to this 25th April, get option chain. What I need to do is that this point is this 229 is pointless. So that is 21,800 put. 21,800 put. What it is trading at? 14 rupees. You see, 21,800 put is trading at 14 rupees. This is not a good thing. So I will be exiting at 15 rupees, let's say. Okay. I will be closing this at 15 rupees. Modify this. And then what is the current price? 22,600. So 200 points lower. 22,600 means 22,400 I have to take. Now 22,400, which is here at 79 rupees. So this is all that I can take. So one lot I am going to add. Now it looks like this. And the edge also I should bring closer. So edge, if I have to bring closer, then what is the edge that we have taken? 21,300. So 21,300 is what price now? 21,300 is at 5 rupees 75 pice. Right here you see 5 rupees 75 pice. 6 rupees, let's say. We have exited at 6 rupees. So I'm going to put it here at 6 rupees we are exiting. But I got to take an edge for this now. right? I cannot leave it unaddressed. So the recent strike that I have taken is 22,400. So again, I got to go say 200 or 300 points lower and take some edge. So that would be 22,100 or so. Let's look at the premium. It is at 34 rupees. Now I have to pay 34 rupees premium. That is okay, because for 1 month I am paying about 70 rupees of premium. Now this is how the payoff looks like, and you can secure this position. So this is one way of doing it. But what happened in reality? That's what we got to check. I'm going to bring it here because you got to see 13,000, 10,000, you see 7,000, because there was some quick action on the downside. You will panic at that time. And thankfully that we have taken an edge at this edge also we adjust, and then you are able to see this sort of holding up to the value. But after doing this adjustment, our profitability came down drastically. From 15k it went to 7k and then quickly recovered back to 13k. Trust me, we are seeing this in 1 day time frame, so you're not seeing all the actions. It will also go so low that you will start worrying, because it went to like minus 2000, no, sorry, 2000 rupees or 3000. That much profits reduced. But I cannot be going on because the video length will become super big. So I'm going to reset the strategy and show the modified version. This is the actual strategy which I am saying that you should give a thought. Same thing, everything, 18th, 25th expiry, 18th of March, 25th of April, and we are going to get the option change of 25th. So let's go faster. So market is at 22,000. Let's go to the same thing. 200 points lesser, I'm going to buy, sell one lot, add position. 700 points above, I'm going to sell one lot. So same thing as discussed in the first one, first option. Same thing, we have same legs we have taken. But what is the change that we are going to do is we are going to buy a weekly edges. Here I'm going to show you both also, so that you will understand how this can help. So what I'm going to do, I'm going to go to what is an immediate expiry, 21st. So 21st expiry I'm going, and then seeing that the market is here, and then I'm going to buy an edge less than 10 rupees. It doesn't matter, less than 10 rupees I'm going to buy. So at 350, this is one edge I'm going to buy. Okay. Here again, I'm going to buy something less than 10 rupees. So this is how the payoff looks like, right? Don't worry about the payoff, how it looks like. This is to bring down the margin money. It has no significance. And I'm going to run this strategy. Let's see what happened. Okay. Here I'm going to go, probably initially we will go in 1 day time frame, because a lot of time gets wasted. So let's see. This was okay. Now the payoff was showing absolutely flat, and suddenly you are seeing a 4,000 rupees profit, right? So that is all because of weekly edges. Now these two would have become zero. All right. Now these two would have become zero, and I'm going to exit this at 0.05. No more thinking, just execute it at 0.05, and this again at 0.05. So the weekly edges have got executed at 0.05. Now what I have to do, I have to go to the next week expiry, and which is 28th, and get the option chain for this. Also I have to select a 28th payoff, correct? And getting option chain, here you can see this is going to show the option chain for 28th of March. And here again I am going to take less than 10 rupees buy, less than 10 rupees buy. You can also take very small thing, but only thing is that if the market crashes, you don't want to lose anything. So for that reasons I am suggesting this. Upside I am keeping say 5 rupees. Okay, let's say 5 rupees I am taking. Okay. Now I'm going to run the payoff now. You see what happens. Now I'm going to show what happens to this position. We were at 4,400 rupees profit. What happened after that? 5,000, 6,000, 7,000, right? And what was the maximum profit that we were supposed to make in the strategy? Somewhere that you got to check with Sensible, it was showing somewhere around 14,000 rupees. Already 50% is obtained. You want to close this and then close all the positions and then create a fresh uh, position from the start. Very well and good. But let's say we don't know anything. We continue to do this till 1 week before the main expiry. What would have happened? It's not a good idea. Generally, when market is offering you money, you should take it and then switch your positions. But assuming, let's say we have strictly said only 1 week before I'm going to close, and I'm going to take edges week on week. Let's say that. Okay. So here again, I am going to lose some money. 0.05 I got to close. I'm closing it. 0.05. I'm closing the leg. Going to buy the next week expiry, which is April 4th. Payoff I wanted for April 4th. And I wanted this option chain. Okay. So where is the market? Market is at 22,177, right? So here I am again going and then taking a edge of about less than 10 rupees. So here again I am buying, add one position. And the call side I wanted to take a lesser premium because both the sides we don't need to take premium. I am just showing worst case scenario. You wanted to reduce the margin money. For that reason alone I am taking the call side premium. Let's say 5 rupees again I am taking. And this is how the payoff looks like. Let's see what happens in this. 5,000, 7,000, 10K. So it at one point it showed 10K. Since we are in day time frame, it is going super fast. You can comfortably exit at 10K also. So doing it for the 3 weeks we have done this and then made about 10K. Definitely you could have easily booked 10K. No doubts about that. So it is worth it. Let's say I want to further extend this and then go for 11th April. And I'm going to get the 11th April contract. Oh, this is 10th April only. So 10th April contract I have to select. Oh, that expiry was on 10th that day. I think it was Ramzan or something like that. All right. Yeah, 10th April. Get option chain. And 8 rupees. Here it is. Wait a second. Where is it? Yeah, 8 rupees. This one I am taking. Let's say add position. And again, I'm going and taking some 5 rupees for releasing my margin. Now this should work, right? So let's keep going. I'm going to play. So 7,000 rupees. See, when you have done this adjustment, it's not the risk is that it is going, if it goes further, you are going to make loss. If it is coming down, you are going to make profit. And you have got 50% of your projected profits. This is the time that you should close every leg and then again push it, because what has happened, market has already moved up and you do expect market to not further move up. So create a fresh reverse Jade Lizard. That's what we should have done. And I already mentioned that. And worst case, if we have continued without any switch, what happened is we have not lost money. Again, this one has expired, worthless. So I'm going to convert this into 0.05. Let's do it, 0.05. All right. And again, you see, it is already at the edge of the spectrum. But still, let's say we continued. 4th, 10th, 17th, or 18th. So this is the week definitely we should exit, because beyond which is pointless. Definitely pointless. You will be losing money because of the gamma effect. So what is gamma effect and all? I will make a separate video. That's not the focus of this, but then you will lose money if you continue to stay here. And let's say that I go to this option chain and take the same less than 10 rupees premium here. This is one lot I am buying. See, I am buying the close to 10 rupees or 8 rupees premium on the put side all the time. But upside, I am just buying 5 rupees call option just to bring the margin money lower. Nothing else. I can choose to ignore buying that also. It makes no difference. So here again, I am buying for 5 rupees. So this week, we are going to exit and pay off for 18th. And this is what it looks like. So if it goes further high, 16,000 rupees we are going to lose. But if it comes down, it's not worth it. Like only if it is moving so much, we are seeing 25,000, but 16,000 rupees. Already we are at a profit of around 10K last week itself. So it's pointless. Let's continue and see what happens if we had stayed in this trade further. What would have happened? 8,000, 14,000, 16,000. So 16,000 rupees it is showing, right? Now let's say towards the dead end of the day, what happened? Have we made more money? Yeah, almost stagnant at 16K. I think ideally we should book and exit, because expiry day trades you cannot really, holding beyond 12:30 is pointless. 17,000 rupees it is showing. Sir, it is worth it only. No, why we have to exit? We don't have to exit, but as long as you are okay with losing this money, and if you're thinking that the market will certainly go down, then you can initiate this. But I think it is a personal choice beyond which point you want to hold and what you want to earn. Because last week it was showing some 10K, and we added another 7K. This is best case scenario. There are days where market would rally towards this, and then here you see with smallest moves you're starting to lose big money, right? That is a very big thing. Instead, you book the 7K, switch 1 month later, initiate the same position and repeat it. That way, you're taking the money out of the market and also maintaining that position. And from there, if the market reverses, you are happy. You get far more range extension. So that's how you should be doing. But luckily, in this thing, it went in your favor, right? But my sincere advice is, when you are initiating reverse Jade Lizard, if it is giving you more than 60% of the projected profit for the month, for example, if you wait for whole month, you are going to get 10,000 rupees, let's say. If you are getting more than 60%, that is 6,000 rupees, book it and roll over, create a fresh position, and multiple times you can do this, because the kind of risk that you are going to put to your profit by staying in that same trade is far higher. Having come this close, if the market chose to go a little further, your profits are getting by half. From 17,000, it will go to 7,000 rupees. Just very high risk that you are putting your profits in. So when you are closing to the expiry, moving towards the expiry, try to square off and then extend it. So that is the strategy. And you can choose whether you wanted to take a call edge or not, whether you wanted to roll over for the next month expiry or not. All these things that you can decide. And range extension also you can do by closing the put option. And then, like I said in the previous first option that I showed you, only with the monthly contracts, where we closed one leg and then extended. Same things can also be done here, but don't do it if it is near after 10th of April. We should not be doing those sort of adjustments. Before that, if the market has quickly moved and then the puts have eroded, then it makes sense to do that. For example, let me give this very clearly. We have taken this position on 18th. Suppose the market has too quickly moved, and by 28th of March, market has already reached this level. Then you can close that leg of puts and shift it by another 200 points lower strike or 300 points lower strike, whichever is your comfort zone, and then continue to do the weekly adjustments. But after 10th, if the market has moved, now you don't want to move your put options closer, because if you move the put options closer, uh, it will have very less premium, and with sudden downside move, you will lose your profits big time. So keep that in mind. Just do the paper trading, experiment it, and then see how it plays, right? And what else I have to show you? I think we can go back to this presentation and discuss the pros. So it is a low risk and moderate reward, almost guaranteed rewards in a volatile environment like what we are seeing right now. So this is definitely a capital building strategy. Like if your expectations are very small, sir, I wanted to make only like 6%, 7% consistently. We are already making more than 10% in this strategy. If at all you are saying that 6% is what I am looking at, excellent. You can go on to do this. It is absolutely no stress strategy if you're playing in month-end contracts. Of course, it's a choice that you got to make. And then less time investment. If you're going for month-end contracts, like the first option that I showed you, you don't have to watch the market till it moves very drastically on the upside. You don't have to worry. Downside, any side it moves, you are going to get at least 7% returns. Upside, if it is moving, then you got to put some sort of reminder and see where it is. So it is a very less time investment and works only in volatile environment, and it is very rewarding. And patience it is, because 1 month you got to do nothing and then simply wait. Those are the things. And the basic adjustments we have discussed. Just you can switch and make adjustments on both call side and put side, depending upon how the moves, in order to optimize your profitability. Weekly expiry, it demands more adjustments, and market is very much volatile these days. So in order to make adjustments every week would be very stressful thing. So you got to decide how you want to play the margin game. Whether you want to do one time of put buy on the monthly contract, 80 rupees, 100 rupees I'm willing to pay, and I don't want to really look into the adjustments on the put side down, then profitability will come down. So this is purely for low capital traders. And you can do further more refinement and then increase your winning odds by deploying more money and then converting it into a short straddle or strangle. Many things can be done. If you have more capital, you can convert this Jade Lizard, Reverse Jade Lizard into a short strangle or short straddle. Many things can be done. So keep that in mind. This is purely for educational purpose. I'm not SEBI registered. Like I said, please do paper trading. Try and experiment. This is your money. And observe any strategy that you see in this series, at least for 3 months. See the kind of results. Compare which one is suiting your risk, which one is suiting your expectations, and how it is causing stress, what sort of things you are okay with. Analyze and then decide. When you are doing a real deployment of money, then it will help you decide, okay, out of this 8, these 2 are good for me, or these 3 are good for me, and so on. You can go on to make some personal preferences and choices. So do paper trading. That's my sincere advice, and thanks a lot everyone.